This is Fair Value Finder, and today we are looking at the Procter & Gamble Company, ticker PG. They came out with earnings today, which helped them go up as high as 5%. They closed the day nearly 3.5% up, and we're going to take a look at why that is, and is the stock worth it? Because this is a stock that I held for a little bit. I sold out of it a few months ago for $144. So it is up $12 a share since I sold out. But we'll be looking at why it is that I sold out, and I'm not upset about missing out on $10 in gains. So I bought in $100 a share March of 2020, which everyone knows that was the bottom of the market. And then I sold out at $144 a share January of this year. We see here the technicals as we typically start with. We have a nice uptrend going from October of 2018. We have a few touch points. It touched in 2020, March of 2020, and again in October of 2022. And we've been on a downtrend since April of 2022. And today we finally broke above that downtrend, gapping up off these earnings. And we broke through this resistance point at the 152 level. And our next resistance point is the 164 level. So we'll see if it has momentum to go up that high, or if it's just going to use this 152 level as a support. And now we'll get into the fundamentals of the stock, what the fair value was at the end of 2022, and what trend the stock is on. So we look at the top line revenue. That looks good in my 5 to 10% preferred range, with a 5.8% compound annual growth rate, 5.4% in this last year alone, moving from 67.7 to 80.2. The cost of goods sold is moving in the opposite direction than we want it to. Growing compound annual growth rate 6.6%. This last year, 13.6%. Those are red flags. The fact that it's becoming more expensive to produce the product is not a good sign. And from what I've seen in these earnings so far, that trend continues, and it's just becoming more expensive to produce the product. They're cutting into their gross margins. We move to the gross profit. The gross profit is trending upwards on a compound annual growth rate, 4.9%, but there was a dip in 2021 to 2022, 2.5%. And the net income, there was an anomaly in 2019, very low net income, which is giving a extreme compound annual growth rate. But the 3% that we see from 2021 to 2022 is good. And we can look at the chart and we can see all of these numbers. Revenue is trending good. Expenses, that's not a very good trend that we like to see. The cost of goods, not a really good trend that we like to see. Gross profit, kind of all around. It hopped up in 2021 and then dropped back down in 2022. And the earnings before interest and tax is kind of a trend we like to see. It was a little low in growth from 2021 to 2022. And we'll get down to that in a minute. Net income is what we just touched on. Expenses. Compound annual growth rate of 5%, 7.3% growth from 2021 to 2022, not trending in the right direction. So both the cost of goods and the expenses are trending up, and we are seeing it's just getting more expensive to run this company and not bringing in the top line revenue needed to offset these higher expenses. The earnings before interest and taxes, again, 2019 was an anomaly, but it was up 2% from 2021 to 2022. We'd like to see more, but growth is growth. Gross profit, it fluctuates somewhere between 45 and 50. 2021 was a good year. 2022 is the lowest of the years that we are looking at, which is not exactly a good sign, but that's still a good gross profit. As I've said before, in the retail space, they look for 30%. So this is a producer. They, of course, would be wanting higher margins, but they have some room to have those eaten away if need be. Net profit was low in 2019. 18% is pretty good. It's been right about the same range. I mean, 2.2% dip from 2021 to 2022. Earnings per share for 2022 was $5.81. So for a 20 PE, we'd be looking at the stock for something under $116. Right now, it's trading for $156. So it is overvalued by that metric. Assets, we see a CAGR of almost flat on the assets. This last year was down about 1.8%. Liabilities, CAGR is trending up faster than the assets. And this last year was a decent drop. 3.2% is much better than the 1.8 that we see in the drop in assets, but still we don't want to see those assets dropping. For book value, we're looking at negative numbers. If you see my other videos, you know that's not something that I want to see. That's a huge red flag. It is trending better. The lowest that we're looking at was 2022, down 1.9% CAGR. It hopped up in 2021 and then back down in 2022. We'll see what 2023 brings. Free cash flow. The free cash flow is trending upwards on a compound basis, but it was down almost 13% from 2021 to 2022. The share count is trending down. That's what we like to see. It looks like almost every year they're buying back 1.5% of the stock. Shareholders' equity, it's mostly flat. There's not a whole lot of change in this number. It says it's trending down 0.1% on a compound basis. This last year it was up 0.4%. There's not a whole lot to say for that. And then for the dividend, they are a stronger dividend payer. They grow it around 5% a year. It looks like on a compound basis, it's 5.3%. Right now they pay an annual, well, they pay it out quarterly, but the annual amount that you'll be getting paid is $3.65, which based on my 3.5% dividend calculation, I'd be looking to pay $99 for a stock that pays that kind of dividend. So again, that's showing that it's overvalued by quite a bit. Book value, of course, is giving us a negative fair value. The free cash flow is pretty good. It's one of the better metrics here. It's giving us a fair value of $113. And then the return on equity, we're looking at about 30%. 2019 was an anomaly. We have 30.7 and then 31.5 for 2021 and 2022 respectively. So I'm coming up with an average fair value of close to $110. If anything, we'd be looking at a growth rate of 5 to 6%. So maybe I'd be willing to pay up to like $115 for the stock. As for earnings, last year's earnings came in $5.70 on a diluted basis. They announced earnings today. They came out with $1.27 a share. Based on the weightings of last year, we'd be looking at $5.44 on the year. Analysts are projecting $5.83. We will see how that plays out. But even that would give us a fair value of $116. So everything that I'm looking at, this stock is overvalued by upwards of 50%. It's more of a $110 to $115 stock, not a $150 $55 stock in my book. So we'll look at the earnings and see if anything's changing with these numbers. But I've already glanced at them and it's a lot of the same. All right, now let's take a look at the earnings. So I already looked through this and highlighted some of the key things. They summarize everything up top. Net sales were up 5%, organic sales up 7%, diluted EPS up 6%, core EPS up 3%. And then they give us the comparison between 2021 and 2022 for net sales and diluted EPS. We can see the actual numbers here for everything. They say that their earnings were helped by an early extinguishment of debt. That is a good sign. We like to hear that. The company returned nearly $19 billion of value to shareholders in fiscal year 2022 through $8.8 billion in dividend payments and $10 billion in share repurchases. And we saw that as the trend. They're buying back 1.5%. They're a decent dividend payer. They could be paying higher, but it's not awful. They show us actually by category some numbers. So we notice that the volume is down on, it's either flat or down on nearly everything. And the price is up. So they've been raising their prices. They have some sort of pricing power because they've been raising their prices almost 6% on most categories. And it's only seeing a drop of 1 to 3%. Like they rose baby products 6%, no change in volume. Fabric and home care, they rose 10%, only 1% drop in volume. So they do seem to have some sort of pricing power, which is going to help them. But apparently they're not raising these prices as much as the costs of production are raising on them. And they get into talking about that stuff. They talk about lockdowns in China had an effect on them and reduced operations in Russia, but they still saw growth. So they saw a gross margin decrease of 370 basis points versus last year. The decline was driven by 450 basis points of increased commodity costs. So producer inflation is a huge effect on them. And that leads them to raise their prices and leads to consumer inflation, as we see 6 to 10% across their products. 80 basis points on higher freight costs, 40 basis points on other increased costs or productivity savings, 20 basis points on product and packaging reinvestments, 130 basis points on negative product mix, and these were all partially offset by 390 basis points in pricing benefit. Their administrative expenses decreased by 340 basis points. So they're trying to drive down the expenses that they're capable of driving down while inflation is eating away on the other end of their expenses. 200 basis points of overhead savings and marketing efficiencies. We see a EPS expectation of $5.93 from them, an increase of 2% over last year. I believe that's higher than analysts are expecting, but over the past year, 3 of the 4 quarters, they came in over analyst expectations, and 1 quarter they came in at expectation. So now we'll get down into the actual numbers, and we see that net sales were up 3%. That's good. That's a little low. We like to see 5, but this is on a quarterly basis. Costs of products sold up 10%. Gross profit down 5%. And this was the same story that we were looking at on the annual financials, where they're growing their revenue, their net sales, they're growing year over year, but their expenses, their cost of goods keeps increasing on them too, and it's eating away at that gross profit. And we can see The annual numbers, we've already looked at those. Earnings before income and taxes was up 2%, and the net earnings was up 5%. And here's the actual sales numbers for the categories that we saw above. We don't need to get too deep into that. We are going to take a look at the assets and liabilities, I believe, are right around here. Yes, total assets. So their total assets are down a little bit, approximately the same amount that their total liabilities are down. As a percentage, the liabilities are down more than the assets are. But again, we don't like to see those assets going down. We like to see them going up. The liabilities going down is good, though. And they mentioned that they were paying down debt. So now we're going to look for some of those key words that we keep looking for. So we're going to look for growth. We're going to look for decline. We're going to look for inflation. So growth, that's just a term. Yeah, they use the term a lot. What was this? P&G's team execution of our integrated strategies delivered strong top-line growth, earnings growth, and significant cash return to share owners in the face of severe cost and operational headwinds. So they think that they're doing good. Decline, volume decline due to pandemic-related lockdowns in China and reduced operations in Russia, which we see mentioned throughout. So they mention the word decline 5 times, and in each they talk about Russia and China, which means that if things clear up in those countries, they could see a bit of a bounce back. They still saw growth without them. Inflation is our next keyword that we're going to look at. And they do not mention inflation. They did mention increased costs throughout. So without directly saying inflation, they mentioned it. But that was the earnings for Procter & Gamble. I give it a sell set rating personally. I mean, I sold out of it a few months back. I would not buy back into it at this level. I'm sure people are buying into it because the expected recession, and typically a company such as Procter & Gamble performs well in a recession, but the financials just do not support the market value that I'm seeing. And neither do the technicals either. I think that the stock is somewhere in the $110 to $115 range. I might be looking at getting back in if it ever dips back down to there, but it seems to be trading at quite the premium. I want to thank you guys for watching, and hopefully you learned something. I will catch you guys next video.